What's up, people? Welcome back to Invest with T Claus. My name is Tevi, and this channel is dedicated to my investment journey, along with coverage on crypto, Tesla, Neo, Virgin Galactic, and ChargePoint. Come for the information and stay for the perspective. So we haven't talked about ChargePoint in a while, but the last time we did, market started the week off low, rallied through midweek, and sold off sharply on Friday. Basically, this week was a repeat of that week. It is Labor Day here in the US, and as a result, the stock market will be closed tomorrow with trading resuming on Tuesday, September 6th. Now, my dad asked me a couple of days ago, why did the market sell off? Well, there's always a bunch of reasons why that happens, but I'll at least provide you with the two biggest macro reasons in this video. From there, I'll jump back to the main topic, which is ChargePoint. I'll cover the earning results and the major announcement ChargePoint dropped this week. This is a big one. Then go over where analyst ratings are now coming out of the earning call and give you my thoughts along the way where I believe ChargePoint goes from here. As always, this isn't to be taken as financial advice. I am not a financial advisor. This is my personal approach to investing and the thought process behind it. I'd recommend watching all the way through so that you don't miss out on any pertinent information I'll be sharing. Drop this video a like if you haven't already and hit that subscribe button. Those are two easy ways to show your support to the channel and help it grow if you appreciate the content. All right, let's get into it. All right, so why did the market sell off? Well, to answer my dad and anyone else wondering for that matter, the short answer is, in these uncertain times, market participants are always looking for any reason to sell and protect their short-term gains. Basically, the sell into strength regime is still a dominant one in this bear market. Now, the two big headlines I'll point you to. The first one relates to the job report. Judging by the headline, this should have been a positive, right? Well, it was until people realized that a strong labor market means the Fed doesn't have to throttle back on raising rates. This data continues to support what the Fed already told us, and this strong labor market is the main reason why the NBER hasn't declared us to be in a recession yet. So there it is. The second reason relates to Russia cutting off gas exports to Europe indefinitely. My guess here is that they probably did it to retaliate to the price cap being imposed on their oil export by the G7. Regardless of the reason, geopolitical tension is like kryptonite to markets, right? We already know this. And when you consider that energy has been the single biggest driver of inflation globally, you can see why people are nervous. As much as this is challenging near term, it makes that much more of a stronger case for why you want to be invested in a company like ChargePoint. Now, speaking of ChargePoint, they had their earning call this week, and depending on what consensus you look over, they either beat or miss. That said, keep in mind that the notion of a miss only relates to what analysts on Wall Street were expecting. So if anything, ChargePoint coming short of those expectations could also mean that those analysts, frankly, just suck at forecasting. So anyway, keep that in mind. I personally keep track through the consensus reported through the Robinhood app, which aligns with the overall market consensus. And by that measure, ChargePoint delivered a narrower loss than expected at 18 cents versus a consensus of 22 cents. Now for some highlights, after 3 months of declining gross margins, they had a reversal which they attributed in part to clearing up their backlog and increased sales volume. Revenue came in at $108 million, which exceeded the top end of the quarterly guidance. For the record, guidance was $84.1 million, so a significant beat here. The 93% year-over-year revenue growth is impressive, but the bigger significance here is the accomplishment of crossing over $100 million in revenue in a single quarter. Now, they maintained their full-year guidance of $450 to $500 million. Some criticized them for not revising the guidance higher since they continue to beat. Personally, I think this is a prudent move considering they are already delivering above and beyond their original projection for 2023, given when the company initially went public in 2020. So as far as like forecasting and projections, they're pretty good at what they do. And stealing a line from their CEO, Pasquale Romano, and I quote, "Demand continues to grow for our portfolio of industry-leading charging solutions for every vertical in both North America and Europe." End of quote. During the Q1 earning call, they reported that they had over 50% of Fortune 500 companies as customers. They now clarify that number to be 53%. And interesting names I don't recall seeing on the list on the commercial sites are Fidelity, NASA, Netflix, Rolls-Royce, and on the fleet side, PepsiCo stands out to me. The growth is there. Interestingly enough, I was shopping at my local Target, and the first ChargePoint chargers have been added right alongside Tesla's. They still need to be plugged in, but that's really cool to see. That wasn't there 3 months ago, so we're making some progress here. The other big news that dropped this week was the appointment of Pasquale Romano as a member of the National Infrastructure Advisory Council, or NIAC. I personally didn't know this agency existed until this news broke. It's essentially a group of executive leaders from the private and public sector The council they form is essential for operating the critical infrastructure essential to modern life. Sounds fancy, and I'd say that it's a pretty big deal given what it is. Now, the council advises the President of the United States, which is no small feat, on how to reduce physical and cyber risk and improve the security and resilience of the nation's critical infrastructure sectors. Again, that's a pretty big deal. If for some odd reason you aren't convinced yet on a long-term positive outlook for ChargePoint, this news here, in my opinion, is a massive vote of confidence that this is a company you want to be invested in. Electrification is undoubtedly at this point the way forward, and ChargePoint has become even more key to materializing this critical infrastructure supporting the electric mobility future. That's a mouthful, but that's exactly what we're talking about here, okay? There's no other way to put this than this is huge for the company and for investors alike. With ChargePoint currently on pace to deliver or exceed their yearly guidance, the analyst consensus rating was upgraded from a moderate buy to a strong buy. Yes, the stock lost 5.10% this week, but it is up by 6.69% overall over the last 3 months. As of this Friday close at $14.50, the consensus price target for ChargePoint is $22.07. That is good for a 52.21% upside from current level. The consensus price is a bit lower than the last time I covered ChargePoint, but it does make sense if you consider that most analysts had to revise their valuation a little bit lower to adjust for inflation risk. The high-end projection remains at $34, and the low end of the spectrum is slightly lower than before, with now $15. We've traded beyond the lower end of this range multiple times already, and it makes more sense to me that we would push closer or beyond the consensus price by year end as the macro picture improves rather than go lower. Now, looking at the trends from the technicals also support this view. You can see here that for the past 3 months, the price, that's the green line, has been in this narrowing trading range. The 50-day moving average, that's the pinkish line, currently sits at $14.60, and the 200-day moving average, well, that's the blue line, is at $15.69. That break above the 200-day that you're seeing, that's pretty bullish, especially because we came back to the support band at the 50-day and have been riding that ever since. If you zoom out to the full year view, you can see that we haven't crossed over the 200-day since the peak of the market in November of last year. And so the way I think about this is that if we stay on this trajectory with a narrowing channel, it leads to a golden cross, right? And that would be full confirmation that the trend has reversed. And so for some final thoughts on this, the last time we spoke about ChargePoint, I pointed to June as the month where we could see full market capitulation as a result of the Fed balance sheet reduction starting. Between that and the record high inflation reading, the market did capitulate on June 13th. Now, ChargePoint, similar to NEO and Virgin Galactic, bottomed a month earlier in May, since all 3 of these companies are non-revenue generating and were the first that got cut out by institutional investors. Since then, we have been in an uptrend, albeit choppy, but it is an uptrend nonetheless. And in case you haven't noticed or haven't realized, any shares that you would have bought back in May has over doubled already before giving back a little bit of those gains. The bottom line is this. There are still plenty of headwinds ahead that will inject volatility into markets. And just to name a few that we know of already, the next leg up of the Fed balance sheet reduction kicks into high gear this month. Then we have the next CPI reading on September 13th, which will be key. Once we make it past that, then we have the next interest rate hike, likely 75 basis points. Then past that, we need to get through earnings season in October and midterm election later in the year. And that's for the US. That said, the fundamental picture for ChargePoint is only getting brighter, right? And so I will end with virtually the same comment I gave you the last time, which is these are the times to be loading up within your means while remembering to keep some cash on the sideline to make the best of those deep red weeks that will no doubt come as a result of all these headwinds I just mentioned. Personally, that's my plan, and that's how simple I intend to keep it. But with that, that's where I'll leave it for today. Don't forget to drop this video a like if it helped you gain a new perspective, and share with others who you think could also benefit from it. For my newcomers, subscribe and don't forget to ring the notification bell so that you too can stay in the know. I'll be back on Sunday for my weekly video. Till then, you can keep up with me here on Twitter. Thank you for watching, stay humble, hustle hard, and I'll see you in the next one.